Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully all of you had a very good day today. And in today's markets, guys, well, unfortunately, we had a landslide of red. Everything started off fairly well in the morning. We had a gap up open on the SPY and on the QQQ, and then 10 a.m. Eastern rolled around, and the markets simply unraveled and continued their downside momentum all throughout the day. We knew that January was possibly shaping up to be the most volatile month in most recent memory, and possibly that this week, well, there was no shortage of volatility catalysts, and this week, of course, or today rather, we did have two of them already. An ISM Services PMI report measuring services inflation that came in slightly harder than expected, but not that much harder than it has been in the last few months. All in all, it was not that bad of a report. And thereafter, we got a very beautiful JOLTS jobs openings report that show that there is much more jobs available in the economy right now, and that the economy is showing some fairly robust signs leading into 2025. All of which was fairly decent news. So what exactly happened? Why did the markets tumble down, the SPY over 1% and the QQQs down almost 2%? Well, of course, guys, we're going to take a look at that in today's video. Number one, what we're going to do is take a brief look at those news reports and exactly why the market is currently saying that good news is currently bad news for equities. Thereafter, we're going to take a look at our major technical analysis rundown of our major stock market indexes, see exactly how things are shaping up after today's sell-off, and thereafter take a look at our big tech names as well and see if we can find any discounts in some of our big tech favorite names. Lastly, wrap it up with a quick glimpse into my portfolio to see some of the trades that I made today with such a volatile day of downside. So a lot to cover in today's video, guys. Let's jump right into the action, shall we? So SPY down about 1.13%, the QQQ is down about 1.78%, and when you look at this list right here, it does not look very good. Financials were down. The only saving grace for the market was indeed in the healthcare sector, helping keep the SPY from being down over 1.5%. Taking a look at the heat map right here, you'll see that most of the damage was concentrated in some of the best names that have been performing the best over the past 2 weeks, largely big tech. Financials was fairly mixed, but the sector did end down. Healthcare was the bright point in the market, and the bottom half of the market, very mixed. This, of course, is a result of the rising yields after today's data points, right? So exactly what happened, guys, we'll get into that right now as a matter of fact, and I'll explain why good news for the market is now viewed as being bad news for equities, or rather good news for the economy is now bad news for equities. This has happened a few times over the course of the last year, if you do remember. Taking a look at the one-day relative, you will see that energy and healthcare, truly the only sectors that were green on the day, everything else to the downside. And when we look at the 1 week relative performance, guys, you will see it is still a very, very mixed market. Most of the sectors still green on a 1 week relative, but we do have some pain points here in consumer cyclicals, consumer defensives, and real estate. All sectors being affected, number one, by either inflation or possibly interest rates as well. So what exactly happened with those jobs reports and that services PMI? Well, taking a look at the services PMI, guys, came in at 54.1, above the expectation of 53.3. So a little bit hotter than expected. But if you've been following the channel for a while, you know that services inflation, more specifically, have been very sticky for at least the last 12 to 16 months. No secret there. And when we look at this read in the grand scheme of the reads for ISM services that we've had over the course of the past 6 months, it is not even one of the highest reads at all. Couple that with the fact that we did get some very nice jobs reports today, JOLTS jobs openings, showing that 8.1 million jobs are available for workers in the economy, contrary to the consensus of 7.7 million. So an additional 400,000 jobs. And in a market environment right now where we have a lot of concerns around a recession, and we know that jobs data is going to hold a lot of weight in terms of equities performance, right? In terms of the bear market, crash, recession scenario, well, these two data points definitely do not point to the fact that we are heading towards a recession anytime soon. It shows that the economy is quite strong. Now, why did the market not like these reports, guys? The jobs report they did like. Why did they have a problem with ISM Services PMI? Well, it has to do with what Jerome Powell was talking about roughly 3 weeks ago when they changed the summary of economic projections for 2025 at the Fed. Take a look at the PCE inflation report that was revised up from a median level of 2.1 inflation in September. This is for the end of 2025, right? They revised it up from 2.1 to 2.5. So it stands to argue when you get a services inflation read that comes in a little bit hotter than expected, it goes in line with pushing the Federal Reserve's thesis that inflation may just be a little bit hotter than expected this year. Couple that with the fact that the jobs report was very solid. It shows a very solid economic backdrop where there's a lot of jobs for people who might lose their current jobs. So a lot of replacement jobs in the market right now. Those are two very decent, well, the jobs report is a very decent thing for the economy. Inflation, not so much, of course. But what do these lead us to a conclusion? It is a conclusion that the Fed will not be under any pressure rather to decrease interest rates faster than anticipated. So today is another classic day where you see the market throwing similar type of temper tantrum around interest rates that they did when Jerome Powell was speaking on December the 18th. So once again, reiterating a similar period in time, early 2024, you guys may remember that all the good data points that were coming out, strong data, strong economic data in terms of manufacturing or GDP, they were met with sell-offs in the market. Why? Because the market wanted Jerome Powell to cut interest rates faster than anticipated, and good data does not lead the Fed to have any pressure to do that in any shape or form, right? Especially not when we're getting slightly hotter than expected inflation reads. Inflation is still high, the economy is still good, so the Federal Reserve doesn't see any need to cut whatsoever. Now, this is very funny, guys, because later in the fall of 2024, we saw the flip side happen where bad data would actually translate into bad performance for the markets. Why? Well, because people started worrying about the risks of a possible recession. So now, apparently, we have flipped the script again, early 2025, where good data is now bad data, and bad data potentially could be good for the markets. Very, very, very confusing stuff, guys. And I do agree with you, which is why, pursuing the predictions of intraday price action movements amidst all this volatility is probably a fool's errand. I focus on the monthly and the weekly trends. In terms of the daily, guys, I've already said for the month of January, they will be putting us through the washing machine with these volatility catalyst events. And I think days like today, either big rallies to the upside like we've seen or big one-day drops are going to be quite prevalent in the month of January. Here's what analysts had to say about the matter as well. Wall Street slumps as good news for the economy is once again bad for stocks. So they flip the script on these narratives, guys, all too often, right? Back in the fall, we know that bad data was actually bad for the stock market, as we saw the August and possibly even September sell-off events when we're getting bad jobs data and whatnot. So this time, the market is flipping again. What exactly do they want? We know that they want rates to come down, but at the expense of what? At the expense of jobs? At the expense of the economy? That would not be good, because then we would go into the recession thesis, which would also be bad for the markets. So today, just Wall Street being Wall Street, guys, being very picky, throwing a little bit of a tantrum over there, just not getting the rate cuts that they completely wanted, right? So here we go. Stocks dropped under the weight of rising yields in the bond market, which jumped immediately after the release of encouraging reports on the economy. Why are the yields rising? Well, because the Fed will not be in any rush to cut rates, especially not after good economic data like the jobs report we got today. One said U.S. employers were advertising more job openings at the end of November than economists had expected. The other said that activity for finance, retail, and other services businesses grew much faster in December than expected, so good for the economy. The strong reports are, of course, good news for workers looking for jobs and for anyone worried about a possible recession that earlier seemed inevitable to pessimists. But such a solid economy could also keep up pressure on inflation, and it could make the Federal Reserve less likely to deliver the cuts and interest rates that Wall Street loves. Expectations for fewer cuts to interest rates in 2025 had already been building for weeks after the December 18th event with Jerome Powell, which sent longer-term Treasury yields upwards. So have worries about other possible Trump policies, such as tax cuts, which could swell the U.S. government's debt and likewise push yields higher. Also some fears surrounding the Trump tariffs, of course. Now, worries from the summer about a potentially slowing U.S. economy have abated, so they're gone, and the 10-year Treasury yield is firmly above 4.5%. We believe the market is shifting into a good news is bad news environment again. So once again, guys, very confusing stuff by Wall Street, I know, but you have to pick the lesser of the two evils at this current time. What does the market like the least, right? Well, do they like the least? Do they prefer higher rates for longer, but a strong economy and slightly sticky inflation? Or would they prefer a dwindling economy, loss of jobs, massive unemployment, and reduction of manufacturing, reduction of economic output, which could put us into a deep form recession of about 6 to 12 months? Well, of course, guys, the market will prefer rates higher for longer. It may not seem that way because of the one-day price action in the markets, but I'll remind you, it's the lesser of two evils. What else do they want? Do you want bad data, which signals a recession, after which you can get some extended sell-off periods and pure fear in the markets like this? Or would you rather have these one-day temper tantrums by Wall Street, where it sends us through the washing machine, it traps people to the long side, traps people to the short side, but all in all, we don't really lose any major levels and nothing much has changed? Well, I prefer that scenario, the volatility scenario right now, rather than potentially being faced with looming recessionary data. So that is the moral of the story for today, guys. I've been saying that January was going to be a very volatile month. They will play out all the tricks in their bag, guys, to get you to possibly close out of your positions, bring in the volatility, bring in the fear. And so far for the month of January, and especially since late December, they have done a great job of that. We have not even moved, not moved from the all-time high levels and not moved from the Jerome Powell flush levels, but it feels as though we're losing a lot of momentum, even though in terms of the levels, that really has not been the case. I will remind you as well, guys, the Fear and Greed Index is currently at fear, market momentum, extreme fear, stock price strength, which is net new 52-week highs and lows on the NYSE, is at extreme fear reads as well. Stock price breadth remains extremely weak at extreme fear zones. We've taken a look at these breadth indicators, guys, and they're not very good, right? Percentage of stocks above the 20-day moving average, only at 38% right now. Now, of course, it was lower a few weeks ago, and it can go lower again, but it usually does provide a decent buying opportunity when we reach the lower levels. Percentage of stocks above their 50-day moving average, still at low reads of about 36% of all stocks. Usually, even though it can go lower, a decent area to buy the dip, especially when you have such volatile events. And lastly, percentage of stocks above their 200-day moving average, another indicator of market breadth. Well, it can go a little bit lower, guys, but usually when you dip under the 50 percentile mark, it usually opens up some very juicy buying opportunities. At least historically, that has been the case. So all in all, guys, the market's still struggling with a few things. Still struggling with sticky inflation from services, still struggling from rising yields, which is putting pressure on equities. Why are yields rising? Because as this good data comes out and inflation remains slightly sticky, the Federal Reserve will not see any need to cut rates faster than anticipated. As a matter of fact, they revised their interest rate cuts from 4 cuts to only 2 cuts for 2025. We got this on December 18th. You can see the September projection was for a median interest rate of 3.4%. They've revised it up to 3.9, which is only 2 small little rate cuts from now until the end of the year. So we will obviously see what Jerome Powell has to say at the end of the month of January, January 29th, when he takes the stand once again and either delivers a further interest rate cut or, what market consensus is right now, a potential Federal Reserve pause. What are we doing amidst this volatility, guys? We are selling options, of course. So all of that intro being taken care of, hopefully you guys appreciated the rundown of what exactly happened today and why we may still continue to have these volatility catalysts through the month of January. We have a ton of them. We have CPI next week. We have a big non-farm payrolls report on Friday. Prior to that, we have the ADP public employment change private employment change coming tomorrow morning as well. And if these jobs reports, funny enough, right? If the jobs reports come in better than expected, like this morning, well, yields are just going to keep going higher. The Fed is not going to need to cut in any sense of urgency. And Wall Street could possibly throw the narrative that they want more interest rate cuts. And because they're not getting them because the economy is good, equities will come down. However, on the flip side, if the jobs reports are bad, right? If the jobs reports come in worse than expected, what comes back? The recessionary narrative, which also puts pressure on equities to the downside. So it's kind of like, if you lose, you lose. It's a catch-22, guys. There is pretty much no way out of this that Wall Street cannot construct a narrative to put some pressure on equities in the early portion of the month of January. So the volatility is definitely here to stay, guys, until we get more clarity, more specifically on Trump's policies come January 20th as well. The seasonality does depict that January is a very volatile month, starting off strong, can dip into negative territory, and usually the market tends to smooth out as we advance throughout the later winter months, which the end of February, late March as well, right? This is the time where we can be building some positions throughout the volatility and possibly find ourselves sitting very pretty in the end of March, April, May, and June when the market does find some more stable ground and when we actually get through all of these volatility catalysts. So that being said, guys, that is your introduction. Hopefully you guys appreciated that rundown. As I said, going to be very volatile, very difficult to predict which directions the market want to pick right now. But one thing is for sure, guys, the S&P will not put in, mark my words, it will not put in any new all-time highs as long as yields keep rising at the fast pace that they've been rising so far. The 10 almost at 4.7, the 20-year yield at almost 5%. You can't, it puts too much pressure on equities, guys. So these need to find a ceiling shortly if you want to see the pressure on equities taken off, and if you want to see these narratives, right, these funny little narratives that Wall Street can put us in, if you want to see these narratives start dissipating and fears around higher interest rates for longer start dissipating as well. So taking a look at the technical analysis portion of the video right now, if you take a look at the SPY, not much has changed, guys. We tried to go for the daily uptrend. I was telling you guys, be careful. Usually this is where they trap, especially into resistance. 602 down to about 596, resistance zone, resistance from the all-time highs, and they did it absolutely again, guys. They faked it out, leading into an all-time high possible breakout. And what did they do? They used two very decent news events today to just drop the markets in a substantial fashion. Now, one could argue that they were using these as a pretext to kind of fill the gaps that were left behind on the Monday opening session and also from last Thursday into Friday as well. So they filled one of the gaps. There's still one remaining gap down below us, and that could send us into further support down here, 585 down to about 576. We also have the looming head and shoulders pattern, which is putting in kind of a deformed second shoulder right here. But we would definitely not be surprised in the month of January, especially if this is how things are going to go, if we just proceed into possible further weekly consolidation, weekly downtrends, and send us into a little bit of monthly consolidation as well. I was talking about this because of the December candle closes. It would look very normal if we come down January, early February, and then by the time, if we took a time machine and we're sitting in June and the market is fine, we're sitting all the way up here, this move down would look very logical. As a matter of fact, we've done it a few times over the course of the last year and a half, 2 years. So they have all the excuses that they can possibly want, all the pretext, all the context, all the volatility catalysts to send us into monthly consolidation, and no one would really think any different of it, right? So that being said, be very careful with your trades in this market. It is not a beginner market right now. This is expert level markets, guys. They will trap you to the upside. They will trap you to the downside, all while maintaining a very volatile range. They could even send us a little bit lower, send people into sheer panic, pure fear mode, even though the fundamental data for the economy is fine, even though the fundamental data for many stocks out there in the market has not changed at all since that Jerome Powell speech, right? So this is all, in my opinion, some surface tensions, right? Some very superficial reasons to kind of bring in the volatility into the markets because the fundamentals have not degraded whatsoever over the last 3 weeks in the markets, especially not in terms of the macro. If anything, they've gotten better. Better retail sales, better jobs openings, and inflation not really upticking that much, just staying kind of planted around that same sticky 2.5, 3% level. But we know that real-time wages for the average consumer are outpacing the level of inflation. So consumers are regaining purchasing power altogether, right? So myriad of factors at play right now, guys. Going to be a very volatile market. My favorite way to play it is when we get these big one-day declines like this. I am writing short puts on my favorite companies under the market. So as of right now, no clear trend. Just watch for the break either way of the direction. This would be a break of the all-time highs for a new daily uptrend. And to the downside, of course, one little gap remaining to be filled. Pay special attention if they break 580 to the downside. That would be daily downtrend continuation. And we may just be heading for the gap fill down here at around 575. I'll keep you guys posted, but it should be a very difficult market to predict for the month of January because of all the possible volatility catalysts that we have every single week. 2 more jobs reports this week, CPI next week. The week after that, we get Trump inauguration and the start to all the big tech earnings. And the week after that, we get Jerome Powell on the 29th. So there's something every single week, guys, that can just erode a very easy and smooth start to a day. You get one bad piece of data and the market can just run with the narrative the whole rest of the day and really make you a little bit nervous. Moving on to QQQs right now. So QQQ is down about 1.78, still in the context of a daily downtrend. I was saying, do not get faked out by these bounces bounces. We know the market can have good bounces, but until they convert into a new daily uptrend, the job is not done. And yesterday was a perfect example of, once again, trapping traders at the high, off of bullishness, off of NVIDIA new all-time highs, big tech, a lot of names, new all-time highs as well. They trap and then they run in the other direction, now coming back into support, 515 down to about 510. All of that being said, watch the key flush zones, guys. 510 is going to be the flush zone. Get a close below that. Daily downtrend, new leg is started right away. And then we look to the larger weekly levels down here at about 500 to about 495, which is a 26 EMA. Also known as the other short-term trend indicator. You can see we've clipped into it a few times over the course of the year so far, where fear and volatility have been at highs. So would it be that foreign to see the markets tumble down here over the next couple of weeks as we move through these volatility catalysts and the market just chooses a specific narrative that they want to abide by? No, it would not be too crazy. That would be weekly downtrend into further monthly consolidation, simply just looking for a monthly higher low for possible further trend continuation. So keep all of those things in mind and be very patient and selective with your trades. It's the best piece of advice that I can give you in such tumultuous times. Moving into financials right now, not a bad day for financials, but still directionless on this trade. That being said, break of 48 roughly to the downside is going to be daily downtrend continuation. And at that point, we have one last fallback zone, 47.70 down to about 47.20. That being said, if we do challenge this area as well, you can argue that it will be a weekly downtrend heading towards the lower end, the 26 EMA, the lower support zone 46.45. In my opinion, this is probably going to be max pain for financials if we do embark on that journey to the downside. That will be consolidation in the financials index from top to bottom of roughly 10%. That would officially be a correction zone for the markets. And you can see when things got quite fearful, quite volatile a few times since this rally started in late 2023. The 26 or around the 26 is usually when we were able to find a local bottom for that fear. So keep that level in mind. We still have not lost any major levels. I'm just giving you some context for the rest of the month. The bulls always have the opportunity of resetting into a new daily uptrend and resetting into a new weekly leg higher. But as of right now, I remain with the mantra that I've stated in the last week of December. I was saying for January, hope for the best, but expect the worst, guys. If you really trade with that mantra in mind, you will find that it's a much easier time to get through the markets when you're already expecting further downside. You are more conservative and more selective with your trades. Moving into healthcare now, the only sector that was keeping us afloat today, down about 0.23%, but not the worst showing for healthcare as a whole, trying to put together a bounce, but let's be honest, guys, the bounce size is still slightly weak. They did do something today that they have not done for a very long time since the later stages of October, which of course is setting up for a new daily uptrend. Now, we would like to see the bulls continue pushing on to this new daily uptrend. We have recaptured the 12 EMA, but the job is not done because we are faced with this very massive weekly downtrend in motion right now, and we know that we don't have any clarity on Trump's policies coming into office, both for Medicare and Medicaid, for your insurance, healthcare companies, and also for RFK Jr.'s policies on what he wants to do for pharmaceutical transparency. So all that policy uncertainty may leave the sector a little bit muted for a while. Nice to see the daily uptrend bounce right now, especially in the major area of support, 140 down to 129. However, the job is not done, guys. Measure this on a weekly basis, and you will see the bounce size as of right now is still very weak, 38.2%. So if you want to see the sector recover as a whole, you need the weekly uptrend. And to achieve a new weekly uptrend, we need more follow-through continuation on this daily uptrend, bring us as high as possible into these guys right there, which is your weekly lower high, and then we'll be able to talk about the possibility of a weekly trend recapture. As of right now, the sector is still fairly mixed and one of the more weaker sectors in the market. Moving on to semiconductors, and as I was saying yesterday for semiconductors as well, I will not close this box of resistance green for support until we close a weekly candle above 260. As you saw yesterday, what did they do? The same thing that they've done 3 times in the past. They make you believe they're going to break the resistance range, trap you at the top, everybody goes long, everybody buys call options, NVIDIA, Micron, everything like that. What happens the very next day? They send us down, more correction mode for the SMH. So as of right now, resistance stays planted, 260 down to about 250, right? Be very careful, guys. We should be buying down here, not here. Here is when we should actually be selling or covering some of our positions, knowing that January is going to be a very volatile month. I still love semiconductors. I think they're going to have a beautiful 2025, but maybe the month of January across all indexes is going to be a bumpy path without any clear, meaningful directional breaks one way or another. That being said, daily uptrend is still healthy for the industry right now. Anything pretty much above 242, looking for a daily higher low for possible further trend continuation. You can argue we're coming into these guys right there, could provide some short-term support for a little bit of a bounce, but until we successfully break above this level right here, close a few candles on the daily, and close a weekly candle above here, we cannot say that we are all clear right now, even though it is looking very nice like a weekly trend expansion. We will see how the weekly close happens on this chart right here. All in all, not looking the worst for semiconductors, but today definitely soured the sentiment, the very positive sentiment that we achieved yesterday in price action. Moving into the Russell right now, down about 0.8%. Not the worst day for the Russell, all things considered, down less than the SPY and the QQQ, but also not a very good day. If I pull up the IWM or the Dow Jones, you're basically looking at the exact same chart. Why? Well, because the IWM sector weighting is a lot of financials, a lot of healthcare, and a lot of industrials. And today, healthcare was probably the saving grace for the markets and the saving grace for the IWM as well. That being said, overhead resistance stays put, 232 down to about 225, and we know the bulls have been weak, guys. Yes, they tried to go for a daily uptrend, but daily uptrend into where? Unfortunately, into resistance, not only horizontal resistance, but moving averages as well. We will see how this one plays out, but it's not looking the best on the weekly time frame, guys. If this indeed is a lower high for lower low continuation into the month of January, we will be looking at 216 down to 207 for support. This is an area where I would not mind revisiting the Russell trade, but as of right now, we are trapped between two levels. Trapped between resistance, which currently stays put at the all-time highs, or roughly the previous all-time highs, and below support, which is the prior all-time highs from 2020 and 2021. The 50 EMA on the weekly is there as well. I would like to see the markets come down into here, pressure the support level, couple that with daily oversold conditions, we possibly could get some very decent entry. Daily oversold, not there yet. If we do come down here in a rapid fashion, test this 200-day EMA, the green line right there, could provide us with some very nice entry opportunities into small caps if it's something you're looking to do. Moving into the Dow Jones now, Dow Jones down about 0.42%. Not the worst showing for the Dow Jones, but definitely not the best. This one was actually green to start the day and flipped all the way into the red. Now you might notice I had already labeled that line right there. Very important, 42,176 roughly. Why? Because if we lose it, daily downtrend persists, and you flush the lows that we've been trying to hold for the last 3 weeks of trading. If we do come down, next short-term area is down here about 41.9, and then the big one, of course, is down here 41.3 with the 200-day EMA, and also you do have a very nice level of weekly prior resistance, which should be support, lining up with the 50 EMA on the weekly. So this is the big one, guys. If the Dow Jones rolls over and flushes this very important level, 42,200, that will be weekly downtrend confirmed. That will be monthly consolidation definitely underway. And then we just embark on one more month of monthly consolidation. It would not look too strange if they establish the higher lows right around here. That's that same 41.3 level I was talking about, guys. 12 EMA, it would not look so awkward if we come down into here January, early February, and then rally throughout the early stages of 2025. That largely is the expectation for the markets. As I said, hope for the best. I want the markets to do this, but if I'm expecting the worst and expecting moves down here, I'm holding my buying power, being very patient. And if it does come down to some of my larger levels across all of these indexes, I will be ready to buy the dip in a very big fashion. Now let's move on into yields a bit because we didn't cover them. So obviously the 10-year ticking up today to almost 4.7 and the 20-year yields as well. As you can see in terms of technical analysis, guys, well, who's in control here? Largely the bulls. We had the monthly downtrend underway, and then unfortunately when the Fed started cutting rates and the market did not agree with them, then you have the move higher in yields. And in my opinion, guys, yields, even though they may peak out soon, there's nothing to say that we can't just stay sticky around here and oscillate the same way we've been oscillating for the last year. This is a very wide range. Can we oscillate in a tighter range between 4.7 and 4.25 as we move through these inflation, sticky inflation, interest rates higher for longer or not, economic data and stuff like that? Absolutely, guys. There's no rush to bring these yields down whatsoever. Weekly uptrend is completely in control by the bulls right now. Longer term yields are pure supply and demand, guys. So if you do not have people flocking to them for one of two reasons, being, number one, people think that the yields are going to become even higher. So if you expect yields to go even higher, you're not going to lock in these yields right now. At least foreign governments and foreign institutions have not been doing that. Number 2 is possibly the opportunity cost. The SPY and the QQQ have put in record years back to back, over 20% each pretty much, and the opportunity cost of being stuck in bonds while equities are rallying 20% a year, when worldwide, a lot of other economies are in recessions. A lot of nations in Europe are in recessions. A lot of nations in Asia or in Latin America as well are in recessions, and the best performing stock market of the last 2 years has largely been the US stock market. So you have a lot of demand, foreign demand for US equities and the US dollar, and that of course is not finding a bid for bonds right now, measured by the TLT. TLT now flushing 86. Now, do I believe TLT is a possible good candidate for a long-term trade? Yes, but the key focus is on the words long-term trade. It's perfectly fine to be building some positions here, but extend your timeline. We know, guys, that the problem this year may be sticky inflation and rates higher for longer. Don't take it from me, take it from the Fed. This was their direct guidance themselves, right? So when we're expecting that, you cannot expect for TLT to fly. The only time TLT will fly will be in the context if we get very bad recessionary data and we start going into a recession. The Fed will have to pretty much cut rates in a very rapid fashion, and that of course will alleviate the pressure on the yields. All yields across the boards will start tumbling, and that is when the TLT will get the most amount of lift. Can we find a local bottom on TLT soon? Sure, probably, but are we guaranteed a very smooth and quick recovery thereafter? No, it will be very slow. Most likely, this is a weekly chart. You see how slow this one moves, right? It'll be a very slow and methodical, slowly recovery in the bond sector as a whole. As of right now, not my favorite trade, but if you want to build a longer term position, now is most likely a better time than not. That is it for the yields in terms of crypto. Crypto also, I mean, all of the risk on assets guys today, they took a bath because yields were higher. The expectation for inflation was higher as well. And just not a very good day for risk assets, right? Risk assets need a green light. There needs to be no hesitation in the market narrative right now. And so Bitcoin had a very bad day yesterday, but down about 5.22%. That being said, they didn't really lose any major levels as a whole. This was one big push. What were the bulls trying to do? Well, there was a daily downtrend, nice engulfing move, got stopped out by resistance here a little bit, 101 down about 98. And now we're just going to be searching to find a daily higher low and try to embark on that daily trend change for the bulls. That being said, I was saying, this might end up with a lot of other sectors, right? You can notice some common themes. SPY, QQQ, semiconductors, a lot of those industries have been just trapped in the same range of consolidation roughly for the past month and a half of trading, and Bitcoin has largely been the same. Trapped between overhead resistance 101 down to 97 and below support of about 91 down to 88. So I'm a big fan of buying down here and then possibly liquidating some of the trades in this area right there. So as of today, after this one-day drop, I did open a new Bitcoin position, selling short puts under the market. And of course, my cost basis is going to be down here. So I want to buy the dips here and possibly be riding them and selling the positions up here. As of right now, this market remains a range-bound market on Bitcoin. The weekly does depict the exact same thing, although you have to be careful. If we flush 91,400, this will be weekly lower high into weekly lower low. That could be interpreted, well, it can't be interpreted. It will be a weekly downtrend in that moment, and we'll just be embarking on a little bit more monthly consolidation. Same thing as the indexes on SPY and QQQ, guys. Monthly consolidation just means we're going for a monthly higher low, and we do have some ground that we can lose. I would not be surprised if we can come down 87 down to roughly 83 would probably be max pain for Bitcoin in my humble opinion. Over the course of this cycle, Bitcoin usually has drawdowns, max drawdowns of about 20-25% from the all-time highs. You can see that was the drawdown down here, went all the way down, spiked down to some 30s, for example, but that's probably the maximum pain area. I would call it about 85 down to about 80,000, probably the area of max pain, but all in all, the higher time frames would display that we are just looking for a monthly higher low for further trend continuation. Same thing as the SPY, same thing as the QQQ, and if they are going to do it, trust me, January and early February, all the catalysts in the world are there to possibly offer that probability for some further possible downside follow through. But in my opinion, it will be a buy the dip opportunity. That's it for Bitcoin. We'll take a look at more Bitcoin and altcoins tomorrow. But all in all, guys, just pay attention to Bitcoin dominance, right? If you want Ethereum or everything else, just pay attention to Bitcoin dominance. If Bitcoin dominance is not putting in lower lows on this weekly time frame, the rest of the market will just be weaker than Bitcoin. Very, very simple, right? That's why Ethereum was weaker than Bitcoin today as well. That's why the rest of altcoins were weaker than Bitcoin. It's all in relation to the Bitcoin dominance. movements. Moving into our big tech names now. So Apple down about 1.14%, did exactly what I thought they were going to do after a somewhat weak bounce. Downside daily downtrend follow through, flush through the 242, and now we're looking to possibly move a little bit lower. The below support, guys, is very close right now at this point in time. We knew what the expectation was. Breakout, retest, and possibly due for a little bit of a rally here. So the retest zone is 237 down to about 232. Very nice move for 6, 7, 8 weeks in a row. I was saying be cautious. It's not going to last forever. We are going to be looking for the daily or the weekly higher lows rather for further trend continuation. So although the bulls have lost these short-term time frames, I would not be too nervous for this company at all. Coming into a very nice area of support, the 26 EMA as well. And you can see usually when Apple goes on these rallies between the 12 and 26, coupled with horizontal support and maybe even some daily oversold conditions, if we really flush down there quickly, could be a decent opportunity for a little bit of a cheeky swing trade using the weekly time frames as your guide time frame for a little bit of a rally from that pocket of support. Moving on to AMD right now. Not looking the worst today, all things considered, especially since NVIDIA was down close to 6%. All in all, daily uptrend has been achieved by the AMD bulls, looking for a daily higher low, anything above 119, looking for a daily higher low to continue this daily uptrend. This daily uptrend is very important, guys. We have not had a daily uptrend in a long time. We had one here, you can argue, late November, but it was pretty weak. This one does look a lot better, recapturing some moving averages in the process. However, the work is not done by the bulls, right? Weekly downtrend is very pronounced. So as of right now, the bounce in terms of the weekly, because eventually we will need to recapture the weekly time frame too, the bounce is almost about 55%. Not the worst, but I want to see the bounce come at least into the 135, which would be the 618 level, or even higher, 138, which would be a 70% retracement, a 78% retracement rather. Why is that important, guys? Because we have no higher time frames. We do not have the monthly time frame. As you can see, we do not have the weekly time frame either, and now we have just got the daily. So this is step number one. It's looking good, but you want to see the bulls push a little bit higher. They have the daily. Now it's time to lock in the weekly trend change as well, and only then will you know that your monthly local bottoms are in, and then we can seek to possibly change the monthly time frame in the next coming months. It takes a long time to turn around a monthly downtrend, and changing it on the daily is step number one, but still a lot of work to do for the bulls. In the event we give back the entire move, you guys know me, I will be looking to shop for some short put options under 120, preferably closer to here, 116 down to about 110, the next pocket of available support for the bulls, which is pretty much 115 down to about $100. I want to be getting as deep as possible into this location. In the event the markets continue being volatile, AMD gives back its entire move, because I really like AMD at these levels, guys. You know, you either believe in the thesis or you don't, and I personally do believe that there's better risk to reward on this name than a lot of other names in the market right now. Revenue and EPS growth is very good, the valuation is very good, and they should be ramping up their data center business in a meaningful way this year. Analyst price targets are all well above the current price target, not even close. Well above is the average. And look at the EPS ramp for the next couple of years and the revenue ramp as well. So I'm going to let this data center thesis play out, but in the process, because there is a lot of risk on this trade, I want to be getting the lowest levels as possible. And for me, that is below 120 for some short puts. Moving into Amazon right now. Amazon as well, down about 2.42%. Not the best day for Amazon, but we have not lost any significant levels just yet. We are still pretty much range bound since after Powell. No clear trend direction right now. Keep a special eye on the lows, 218.60, because if you flush those, guys, well, daily downtrend simply continues at that point, and weekly downtrend possibly shaping up to be in motion as well. The lower area of support down here is 214 down to about 208. I'm giving you guys the downside expectations because I think the downside risk right now is a little bit more meaningful than the upside potential, right? That being said, the bulls always have an opportunity to reverse this into a new daily uptrend and go for the weekly trend continuation. However, it's not looking the best, so I'll give you guys the downside scenarios, which is just weekly consolidation, weekly downtrend into lower support, and also into monthly consolidation. And the monthly bulls can definitely afford this on Amazon, guys. It's been 4 or 5 months of pure rally to the upside, one little month of consolidation, maybe early February as well, right before their earnings. You know, would not be the worst case for Amazon whatsoever. We would still just be looking for a monthly higher low into a new monthly uptrend. So I like this one a lot, but I like it a lot closer to 200 to add any further positions. So for me, coming deep into this area of support, if that is the case, guys, I'll be looking to shop for some short puts. 205 down to 200 seems to be a great area for me. Fundamentals on this company are fantastic. Moving on to Google right now. So Google also suffering from the declines today. They were up over $202 this morning, guys. Google had a very nice start to the morning, up over 2.5% almost before giving it all back and ending in the red. Top to bottom move, 2.78. Very volatile market as a whole. Google, contrary to some of its peers, has not lost the daily uptrend. This is still a very nice daily uptrend. Looking for a daily higher low, anything above 188. Just looking for that daily higher low for possible second or rather third attempt at breaking and closing above the $200 psychological level. If we come down too hard, the areas of support is pretty much the 191 to 198 pocket. Not the strongest level, prior all-time highs, and current area of support. The larger level down here, of course, is the 180. And if ever the markets really tumble on the month of January, guys, and I can find myself with some Googles in the mid 180s, I will be writing a lot of short puts and possibly even positioning for some call options for the later stages of 2025. I love this company. I love the valuation of this business as well. And at a 1.43 peg around current price, not the worst valuation in the world, very cheap, one of the cheapest, actually the cheapest in all of Mag 7. So if we come down here to the 180s and get another 10% discount and bring this valuation even lower, I'm going to be a big fan of buying Google, because at that point, it will just be looking for, as well, same thing as Amazon, guys, looking for a possible monthly higher low for possible further trend continuation. So I'm looking at the longer duration timeframes, because we know the daily timeframes in January are going to be very, very volatile and somewhat tough to read. Moving on to Meta right now. So Meta, after a fantastic day of rally yesterday, gave a lot of it back today. However, Meta as well is currently in a daily uptrend, not looking bad. We did not lose any levels, just in daily consolidation mode. Anything above 583, looking for a daily higher low for possible further trend continuation. We will see if they can get it done. In the event we revisit this lower range, well, the support range down here, guys, is about 597 to 581. We will see how they react to it. It's a very large level. It held the test after the Powell test. We will see if they can do it again. And as of right now, we're just kind of consolidating above, very close to the all-time highs, but we have not lost any major levels on the weekly time frame. So as of right now, no levels have been broken, guys. I still do like Meta. Even if Meta gives up the big level and consolidates for the next couple of weeks of time, and we come back down 560, 550, 540, I would be a very big fan of buying Meta down here. But right now, being trapped in the midpoint between two levels, not the biggest fan of playing Meta right here. Come down into here, possibly come down all the way into there. Very likely that I'll be playing it. Moving into Microsoft right now, down 1.28%. Microsoft had a fantastic bounce Monday. We were up 2.5%. And look, from those highs down now almost 3%. Microsoft has been very, very volatile. We know that they just spent they said they were going to spend $80 billion on capital expenditures to increase their AI offerings and data center expansion into 2025. And I do still think that that is money very well spent. That being said, Microsoft on the daily downtrend. The bulls had a very nice bounce yesterday. We will see, because the size of the bounce was actually quite good. Got all the way up to about 75%. So they still do have a chance of changing this into a new daily uptrend, but they have to get their butts in gear over the next few days of trading. Because if not, if we lose this level, guys, and lose the bottom end range here, 420, and come all the way down here, next pocket of short-term support, 417 to about 411, and the 200 daily moving average is sitting there as well. If you lose this and close the weekly down below there, unfortunately, I will have to make this box red once again. Microsoft has struggled breaking out and holding above this area all year so far, but definitely not because they have not been improving their fundamentals. The fundamentals of the business are only getting better, looking quite fantastic. That being said, if Microsoft makes its way down here, 415, 410, I will be loading up on even more Microsoft for 2025, because I think that they'll be having a very good year. Moving on to Netflix right now. So Netflix continuing on its decline. Netflix used to be in a period where they were almost up every single day, and now pretty much since late or mid-December, we have had a lot more red days than green. That is just how it works sometimes, right? Daily downtrend is quite pronounced right now. The moving averages are about to cross, and I was saying be very careful with Netflix up here. I wouldn't be surprised if we go into weekly consolidation. Now it's literally been 5-6 weeks of weekly consolidation in a row. That being said, the bulls are still in full control of these time frames. Weekly uptrend is very nice right now. The first line of defense will be around this 12 EMA. 860 for the bulls, and it's very good, guys. I mean, we came up very, very quickly. It's nice to see that the bulls are holding up gains, right? 5-6 weeks of time, we have barely dropped from the all-time highs. 5-6 weeks of consolidation, barely down about 7%. If this name had a lot more volatility, you would not be surprised if it would come down a lot more than that. But as of right now, the bulls holding up better than most. Netflix for me becomes a little bit of a swing trade opportunity. If we can dip down back here around between the 840 and roughly 800. I know I'm asking for a lot. I'm just looking for the pocket between the 12 and 26 EMA on the weeklies. It's been a pocket that every time we've come down here since the rally started in pretty much late October of 2023, right? Every time we retest these zones, even in times of fear and uncertainty, usually it does represent a very decent swing trade opportunity for Netflix. So in this range right here, call it about 840 down about 800. That is the pocket that I'll be looking to go shopping, especially if you can line it up with maybe some daily oversold conditions. Could be a good recipe for a trade. Moving into NVIDIA right now, what happened with NVIDIA? Well, if you guys didn't see their CES yesterday, this news release right here, NVIDIA releases gaming chips for PCs, tapping AI features from data center GPUs. If you guys did not watch CES, I highly consider you watch I don't have one on my channel, but if you watch another YouTuber who does like a maybe 10-15 minute recap, one of the more famous ones, of course, not to name any names, but you should get a very good idea of what NVIDIA released yesterday. I watched almost the entire 2-hour presentation, and I was very happy with the products NVIDIA released, and so was the market. The market absolutely loved it. You can see here, NVIDIA had a gap up open this morning. At first thing after the bell, they were up 2%, brand new all-time high. And then unfortunately, the volatility came in, right? Classic trap and run the other way, right? So Wall Street being very unkind to NVIDIA today. Nothing fundamentally changed with the business at all, guys. Everything in their news conference yesterday from CES was very, very cool and very, very bullish for the company. Not so much they didn't dive so much into the enterprise division with Blackwell, but they focused a lot on their consumer products and on the software that they're developing, guys. And to say that these guys are so far ahead of their competition is not an understatement right now. I was very pleased, so I highly recommend you watch a 10 to 12 minute recap to see where NVIDIA is positioned for 2025. I love this company. I'm very bullish on this company, but the price action today, well, was just very volatile. Top to bottom drop, guys, 8.5%. For no reason whatsoever. Trust me, the news was only bullish. That being said, still in the context of a nice daily uptrend right now, they did not want to give us the all-time high break. The retest, well, the retest right now is flushing through the zone that I had identified, 147 down to about 142. That being said, anything above 134, still looking for a daily higher low for possible further trend continuation. But after so much momentum to the downside, guys, it is very possible that we just continue this move and then once again be driven back down into the same range of consolidation that we've been in since the month of October. So we will see if the bulls can play some decent defense. They're kind of running out of ground right there, but if they want to play some defense, would not be opposed to seeing them continue on for this rally, of course. But either way, guys, I am fine with this trade either way. If we continue moving down, I will just write some more short puts in the lower 130 region, which should be a very profitable trade come the next few months in the market. So NVIDIA, obviously today, guys, not the best day for NVIDIA as a whole, but I just want you to understand it had nothing to do with the company whatsoever. That being said, still looking for possible weekly trend expansion, but of course, after a day like today, guys, may just be due for a little bit more consolidation back in the low to mid 130s before trying another attempt maybe later on in the month. Now, moving on to Tesla. Tesla down about 4% today. Same thing, guys. Not a good day for any of the big tech names, as you can see, right? And we are on the watch for daily downtrend continuation, which will be a break of 377. And that would unfortunately lose this big area of support that the bulls are trying to defend so well. 410 down to about 380. That's going to be the mark to watch on the weekly, guys. Still on the weekly, just looking for a weekly higher low, anything pretty much above right now, 330, looking for a weekly higher low for further trend continuation. I like playing this one because it's volatile. If we make our way back down, guys, into the 370, 360 region, I will be writing 330 and below short puts. I think it's a very decent and fair level, a lot more fair than when we were previously at just a few short weeks ago. That being said, be quite cautious with this one because they do have earnings in a few weeks worth of time, but the bulls need to put in a stand right now. If they want to get the new daily uptrend in motion, they have to stand up right now because lose any more ground and you will run the risk of rolling over this daily into further daily downtrend consolidation. And then we will be very quickly approaching 360 down to 330. That is the next big area of support thereafter. So Tesla, I mean, the bulls still have a chance to turn this around, but I will be quite honest with you, momentum-wise, it is not looking the best. I would not be surprised if further consolidation is in order. I will be sitting down here if we retest 360, 360. I've already said I will be writing options 330, 320 lower range down there. Moving on to Palantir right now. Definitely not a good day for Palantir. This is one of the weakest closes that I've seen in a very long time, since the 9th of December right here, closing at the low of the day. Daily downtrend in motion. This is the first daily downtrend on Palantir since back here in October, when we barely flushed the lows. It was kind of equal lows, barely a daily downtrend, right? This one, however, is more significant. As you can see, guys, clear flush of the lows, and we're about to lose the support levels that we established in the month of December, culminating in a flush of $70. The stock closing below $70 today, and this, in my opinion, guys, is the start of very healthy weekly and possibly even monthly consolidation on a stock that has done nothing but rally to the upside and print gains for the last 7, 8, 9 months. I know people, that's not what people want to hear, but we're just being realistic here. All good things need to consolidate eventually, guys. They need to set the monthly higher lows if you want to have a chance of putting in a support level and going higher thereafter, right? Palantir does this all the time, where they put in big monthly moves and then a retest. And then now we have a huge monthly move, exponential move. Eventually, you are going to get a retest of the lower levels. That being said, the bulls are holding on by a thread. We will see if they flush this zone tomorrow. Next stop going to be the 50 EMA on the daily, about 66. But if you take a look on the weekly, guys, 12 EMA as well is at 66 too. So the 66 area is not a bad level per se. We've done wonders in cooling down the weekly RSI, now at much more manageable levels. And this is all just very healthy weekly consolidation, looking for a weekly higher low. At this point, anything still above 41, looking for a weekly higher low for further trend continuation. If you ask me my opinion where I want to play Palantir, it's going to sound very conservative, but if we come down this week and into next week into the low 60s, I will be writing probably in the $50 range for some short puts around this 26 EMA, 55 and under. If I can find some premium down there with some extended volatility in the markets, I will be probably taking that trade down there, but I'm being very patient, very cautious on Palantir. I know it's been a very nice time so far, but now possibly in for a little bit more consolidation. All things considered, guys, if you look at the monthly and the weekly timeframes, I see no major red flags here. Just a stock that has run a ton and now due for a little bit of monthly and weekly pullback. And now lastly, moving into SOFI. SOFI down about 2.49% as well, and the daily downtrend possibly continuing to be in motion. If we flush these lows right here, $14, we're going to head to one area lower, which is again between the 12 and the 26 EMA. Now, I've said this once and I'll say it again, guys. This area of support, I cannot say that we've really claimed it much, have we, right? We've pulled into it. We never really broke substantially above $16, $17. Not enough to say that this is a nice breakout and retest, right? Now we're trying to claw, we're trying to hold on to the last lines of defense down there. But if you lose those levels, guys, there's really not much in our way before the 26, which is down here at about 12. So I'm looking at this pocket 13 down to 12. If they are going to consolidate a lot of the hype plays, a lot of the momentum plays, and put people through the washing machine in the month of January, that is the level that I will be personally waiting for. $13 to $12 on SOFI, I think, is a decent deal for the company right now. That being said, the bulls have not lost those levels just yet. They do have a chance at resetting into a new daily uptrend, putting an end to this weekly consolidation, and this just being 5, 6, 7, 8 weeks of sideways with slight downside bullish or bearish bias, right? Going for the weekly uptrend shift. But all in all, that is just not in the cards as of yet. We need to see a recapture of the daily uptrend because we have not seen it since that Jerome Powell day. And that is everything for your stock market rundown. Now let's dive into a little bit of the portfolio. I'll show this to you very briefly because not much has changed. So taking a look at the portfolio today, guys, there was a few things that we did do in terms of new trades. As I was saying, I'm really waiting for these big volatility days in the markets to start writing some more puts under the market on my favorite companies. That being said, I did find a few trades today, but I'm being very patient, very cautious with my buying power because we know that there's going to be more volatility events the rest of the week, so no need to spend all of our money at once. That being said, I did spend a little bit of money today. Bitcoin, BITX, this was one of the top 5 options plays I was looking for. We want the 49 short puts, which is roughly Bitcoin 89, 88,000 if we come down there. We got 26 cents, which is roughly 0.5%. Very conservative on that BITX trade. We're now slightly underwater on them. I was very patient on them. Took it when BITX was down roughly 9-10%. We just kind of fell through thereafter. We took the short puts right around here, and it just kind of faded away. So I'm all the way down here at 49, which is not the worst level. If you combine this on the Bitcoin chart, right, just visualize this pattern and you'll see exactly where it is on Bitcoin. It's really the lower end of this range, slightly below here, roughly around $89,000. I would not mind picking up at least 100 shares of BITX if we move down there, which is why I wrote the contract. Second thing that we did today as well is I went a little bit heavy on NVIDIA after this dip. I went with a 30-day contract, roughly 30 days, let's call it about 35. February 14th, longer dated put to lock in the volatility, lock in level 140 put for $6.11. Now, yes, I did not get the low of the day on this. We got this one when NVIDIA was down roughly 3.25%, and we know that at the end of the day, a lot lower than that. That being said, I'm just benefiting from the volatility, writing the 140 puts, $6.11 in credit, 611 bucks. So our break even on this is all the way at about 133.89. So very decent average cost. You guys already know that I already have some positions of NVIDIA expiring this week. We have 100 shares assigned at 137. Our cost basis after multiple rounds of covered calls is down around 129. That being said, if we get called away on these shares this Friday, which I do still think is a distinct possibility, they will be replaced with this new short put all the way through February. So if I like buying the stock at 137, I definitely like buying it at 140 minus 6, giving me a break even of 134. And as I said, my next DCA on NVIDIA, if things get really bad, will be in the mid 120s, but I will be looking to milk these contracts and this volatility for pretty much all they are worth. And we also repurposed a little bit of the Uber trade. Uber, you might remember, I had some covered calls on for this Friday, and now since the stock is trading around $66, I was able to write some covered calls again, this time for next Friday. So all we did is a roll forward in premium. We were able to collect roughly 60 cents. I'll show you that right now. In terms of the assignment tracker right here, the covered calls we had for this week were about 30 cents, and then we rolled them forward to next week for about 64 cents in net credit, getting an additional almost 1% for that extra week of trade. And now our average cost on this assignment position that we got at 66 bucks is now down to 64.02. So not the worst trades at all. Those are the only trades that I kind of put forth today because I'm being very patient and very cautious with this market right now. All the covered calls on our leap call contracts are still active for that reason, guys. I'm leaving all of these contracts for the most part covered until the end of the month, where most of those covered calls expire, looking to play the volatility and not looking to give back much profits at all. So I do remain covered, guys. Still cautiously optimistic in my positioning, but you can see I'm playing this a little bit more defensive mode, and I'm being very patient and waiting for the market to come to my levels where I want to buy it. And I'm definitely not chasing any of these pops that we get into resistance, into all-time highs. I'm not doing it, guys. I'm waiting for the volatile days, the days where people are fearful, coming down into big support levels, and then riding below and below the markets on my favorite companies. So hopefully that was helpful today. That's it for me today. Hopefully you guys enjoyed the video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. Would love to have you here, guys. We are so close to 5,000 subscribers, and I would really like your help to push us over that very big milestone. I know it doesn't sound like a lot. Other creators have millions of subscribers, but for 5,000 people to subscribe to my channel, guys, I thank you so much. It means the world to me. I knew this was a possibility, but I didn't think it would happen this quickly. So you guys have made the journey very fun so far, and hopefully I've been able to teach you a few things along the process as well. And lastly, guys, if you have any questions, always feel free to leave them down below in the comments. Tomorrow, I will be doing a few of the tickers that you guys have asked me for in the comment section over the last couple of weeks. We'll spend some time on that at the end of the video, since tomorrow, no portfolio recap to speak of, and probably a lot less macro and context to give. So tomorrow, the video will be a little bit shorter, a little bit more focused on trades. Thursday, of course, is a market holiday. And lastly, guys, if you want access to all of these trades in real time, all the short put trades, the wheel trades, so to speak, the call option trades, the leap trades, the call debit spreads, the put credit spreads, the share swing trades. I do all styles of trades for all account sizes in the Discord. These are all the trades since the inception of the Discord, of course. I always show them, very transparent with my wins and my losses. If that's something that interests you, we also do private morning live streams Monday to Friday for about an hour or two each day. And also additionally, guys, we have private videos in the Discord that I do not show on YouTube, some more advanced strategies, how to grow your account if you have a small account, very advanced stuff that I don't talk about that much on YouTube, psychology videos as well that have helped a lot of my students and fellow traders do a lot better in their trades, get better risk to reward setups. And in the event you also want to talk to me all throughout the day, I respond very quickly. You want to ask me questions about your stocks, your options, and anything in between, long-term portfolios as well. Everything is fair game. You can ask me that in real time all throughout the day. If that's something that interests you, the link to the Discord is down below in the description. Hope to see you in there soon. And if not, well, I guess I'll see you back on the channel, guys. that's it for me today. Apologies for the long video, but yesterday and today had a lot of talk about since we haven't seen each other in about a week's worth of time. Moving forward, now that you guys understand the context of early January and where we're going, we're going to make these videos very short, and it's going to be kind of a, follow along type of thing. So I won't have to re-explain the same concept every single video. Now you guys know what the deal is. So moving forward, a lot of these videos are probably going to be between 35, 45 minutes maximum, not so much closer to 1 hour, but thank you very much for watching nevertheless. That's it for me. Take care. I love you guys as usual, and I will see you tomorrow after the close. All the best in your trades tomorrow. Peace.